morning. Today is Wednesday, November 25th, and thank you for joining us for another edition of the Market Commentators podcast. My name is Jake Wilms. I'm a quantitative analyst with the Milwaukee Company, and joining me this morning is Mike Wilms, who is the Milwaukee Company's Director of Trading and Compliance Officer, a new fancy title for Mike, and of course, Andy Wilms, our CEO and President. Good morning, gentlemen.
Morning, Jake. Morning, Andy.
Morning, guys.
Quick reminder before we get started, as usual, is that there's nothing in this podcast that should be construed as investment advice, and the views expressed represent Mike and my personal views, and not those of the Milwaukee Company. All right, with that out of the way, let's get a recap.
Thanks, Jake. A combination of positive coronavirus vaccine data and a rising number of cases left the market struggling to find its footing last week, preventing it from making a meaningful move one way or the other. The Dow Jones Industrial Average fell just under 1% for the week, and the S&P lost just under 1% as well, and that marked both the Dow's and the S&P 500's first weekly decline in 3 weeks. The NASDAQ composite, meanwhile, was able to eke out a small gain. This week, markets started out with stocks rising on Monday after AstraZeneca and the University of Oxford said they had a coronavirus vaccine that was up to 90% effective, and which became the third treatment this month that was revealed to have effective trial data. The Dow hit its sessions high in the final hour of trading amid news that President-elect Joe Biden plans to nominate Federal Reserve Chair Janet Yellen for Treasury Secretary. Interesting to hear what Mike thinks about that. The Dow Jones Industrial Average topped the 30,000 mark for the first time on Tuesday. Tuesday's gains also put the benchmark up by more than 13% for November, which is its biggest monthly gain since January of 1987. Meanwhile, the small cap Russell 2000 index also rallied by 1.9% and hit a fresh all-time high yesterday. That gain put the Russell on pace for its best month ever, up more than 20% in the month of November alone.
All right, thanks. Let's switch gears to a quick COVID recap as usual. So, unfortunately, more grim news on the COVID front. The 7-day average of daily U.S. infections has topped 170,000. In total, more than 12 million cases have been confirmed in the U.S., along with just over 250,000 deaths. States and cities are implementing lockdown measures to curb the spread of the coronavirus as the holiday season approaches. This, however, will have massive economic ramifications for the U.S. It will reverberate through the start of the next year, according to J.P. Morgan. More than 1 million travelers in the U.S. were screened at the airport security checkpoints on Sunday, a new high for travel during the pandemic, which obviously is not good for containing coronavirus. And in addition, 9 states, Arizona, California, Delaware, Louisiana, Maryland, New Hampshire, New Mexico, Pennsylvania, and Vermont, so not Wisconsin, are reporting more than twice as many new cases a day as they did 2 weeks ago. Officials warn that it will only get worse if people disregard warnings about travel and gatherings during the holidays, and I have a feeling that many will.
Mike, you want to bring us up to date on some recent economic developments?
Well, first and foremost, they moved up the release of unemployment claim information from tomorrow, Thanksgiving, to early this morning. New claims were up more than expected at 778,000 for the week. Market had been expecting 733,000. And the release also contains some information that kind of highlights the true magnitude. There is a pandemic emergency facility that now has a new high of 9.15 million claimants. So in total, there are just over 20 million people in some form of unemployment compensation, whether it's state, federal, or the pandemic emergency programs, versus just 1.5 million a year ago. And then also on the economic front, some of the news releases kind of are creating a tale of two cities, so to speak. You got business on one side and the consumer on the other. Business-wise, the IHS Market Purchasing Managers Index for November came out on Monday. The PMI covers broad segments of the U.S. economy, and two of the major sectors are the services sector and manufacturing. The numbers for the service sector rose to 57.7, which is the highest reading since April of 2015. And it's important to keep in mind the services sector represents over 2/3 of the overall U.S. economy. On the manufacturing side, the index came in at a surprising 56.7 in November versus an expectation of 55 and a reading of 53.4 in October. And for everybody's point of reference, a reading above 50 on both measures indicates the economy is growing. Yeah. On the flip side, on the consumer side, the Conference Board, a private research group, released their index of consumer confidence earlier this week, and it had fallen to 96.1 for the month versus a revised 101.4 in October. Economists surveyed by the Wall Street Journal had been expecting a number in the 98 area, so the 96.1 was kind of a surprise to the downside. Some of the things that might be bleeding into those kind of weaker consumer numbers. One key thing everyone needs to keep in mind is that CDC's rent moratorium expires on 12/31. Estimates are as high as 6.4 million households could face eviction upon expiration of the rent moratorium. And it doesn't take a whole lot of imagination to understand the lack of action in Washington on further COVID stimulus is also having a negative impact on the consumer side. So, one of the other things I think everybody needs to keep in mind is that debt levels are continuing to increase on both the private and the government side of the ledger. Bloomberg had an article earlier this week talking about the fact that there currently are $1.4 trillion in corporate debt issued by what are being referred to as publicly traded zombie companies. And by that, Bloomberg took a look at 300,000 publicly traded companies and found 20% of the companies don't earn enough in this current environment to cover their interest payments. Hence the reference to zombie companies, and that originates back to Japan in the 90s, and most recently had been a reference to a lot of European companies post-financial crisis that haven't been able to earn enough to cover their interest expenses. And currently, China is starting to experience an increase in actual defaults. So, that's something that we're going to need to keep an eye on as a major risk factor in the overall economic mix here. And the other thing that on the private side of things, there now are 44.7 Americans with student loans totaling $1.6 trillion. On average, each borrower owes $32,731. That 1.6 trillion exceeds the total of 1.3 million auto loans outstanding. And amazingly, it's hard to believe, I would say 829 billion is a small number, but that is the total credit card debt outstanding.
All right, thanks, Mike. It was a lot of interesting econ stuff. I actually have a sort of a similar economic topic to talk about, but this is more on the cryptocurrency side. I think something that's fallen under the radar in the financial world is the sudden surge of Bitcoin and cryptocurrencies alike. It's often, shrouded in mystery, and the questions for the average investor can be hard to find and answer. So I think it poses an interesting talking point this week, especially since Bitcoin has surged up to over 19,000 in valuation, and it's up over 160% year to date. And it's not even just Bitcoin. Ether and XRP have been up in huge amounts this year as well. I know that the big thing with crypto that I always think about is their volatility. cryptocurrencies are extremely volatile, and there's a lot of questions about their regulation and how stable it could be as an investment. But the maturity process seems to be slowly happening. Institutions are increasing their holding periods. We're moving further and further away from that manic period in 2017 where all the hype was built up. And this can be most pronouncedly seen in Asia. Markets like Haboy and BitMEX offered high leverage to buyers for Bitcoin and other cryptocurrencies in the past. This created a ton of liquidity, but it was artificial. They were really speculators that were closer to gambling than they were investing in the currency. And now that a lot of that leverage purchases has been regulated away, the markets are starting to stabilize. And even we've seen PayPal have a huge influence recently, opening up their platform to Bitcoin, which is a massive step in the right direction for regulation and incorporating Bitcoin into our everyday financial world. So I just want to get your guys' thoughts on Bitcoin specifically and the cryptocurrency world in general.
Well, I would say, the big deal here was PayPal. It's not really PayPal's not regulating Bitcoin, but
Sure.
its willingness or its ability to accept Bitcoin as a form of payment did give Bitcoin in particular and cryptocurrency in general a degree of legitimacy that they've been really striving to develop. The questions, I think with Bitcoin and cryptocurrency still remain, and that is to what extent will they become generally acceptable by the average person? There will always be I think there's going to be a segment of the market that will accept it. Will the average consumer accept it, or the average business? I can't imagine going into my local True Value and paying for something with Bitcoin, but it doesn't need that level of acceptance to be successful either. So I think there's a place for it, but my rule always has been don't invest in something you don't understand. And I think there's a lot going on with Bitcoin that the average investor does not understand. So I think for most of our clients, Bitcoin or cryptocurrency in general is probably not a good place to park their money.
Yeah, I would agree, Andy. I think that it's really, really exciting, though, to see the possibilities of future, even currency developments and means of investing. If something like cryptocurrency can sprout up a couple years ago in popularity and start to become legitimized more and more as the days go on. You can see this even with the talent entering the industry. There's a guy, his name's Damian Vanderwilt. He was a former Goldman Sachs partner, and he left his job for an opportunity at Galaxy Digital as a co-president, which is a cryptocurrency firm. And you're starting to see these movements slowly happen, and I have to wonder if the talent pool growing for cryptocurrency is going to lead to some substantive changes.
Well, yeah, I think it probably will. I mean, you think about what's happened in the economy, the way the economy has changed. I mean, it's been just unbelievable to the extent to which the way our economy functions and operates has changed in the last decade.
Exactly. It's digitized.
Yeah, and yet we haven't seen that same level of change in the way currency is handled. So sure, there's going to be some catching up to do. And I think there probably is an opportunity to make some money here. It's just not an opportunity that I personally am going to pursue.
Well, I mean, I think the big linchpin, a number of central banks are looking at trying to create a cryptocurrency themselves. That would be the ultimate validation for Bitcoin and the other cryptocurrencies that are out there.
Well, and the Fed is looking to do that too, right?
Exactly.
Our own Federal Reserve is looking to do that. The problem that these central banks have is they can't control that. So if they come up with their own cryptocurrency, are they going to prevent other people from printing or generating cryptocurrency? Like right now, I can't go out and print my own dollars, I don't think. I can't compete with the issue currency.
So
I think that would be an
best
issue
indication or analogy would be to look at the special drawing rights that the IMF tried to issue as an alternative to the dollar as a reserve currency. In where it was a basket of currencies it just never was fully accepted, and it hasn't attained the level of success that everyone had hoped for.
Well,
Andy, I want to pivot back to you if you had a topic for the roundtable today.
I was just going to talk a little bit about a couple of recent studies I came across that looked at the reliability of market forecasts. The first I want to mention is a new study of 3.8 million forecasts from 1994 to 2019. I mean, that's a lot of forecasts by stock market analysts in 45 countries. And it considered whether following those forecasts would have led investors to higher returns. The study compared the top and bottom 20% of equities by consensus analyst recommendations. And it found that on an equal weighted basis, US analysts, as expected, failed to outperform, and that following their forecast would not have generated alpha. One possible explanation offered for why that was the case is that American analysts usually have a preference for growth and glamour stocks, which can lead to, that focus they thought might lead to some of the analysts underperformance. But at the same time, they found that analysts outside of the United States, in fact, analysts in every other developed nation and almost all emerging markets, following their recommendations did lead to meaningful outperformance over time. And the study also found that in low sentiment phase of the market, bear market or a financial crisis, analyst recommendations were more correct than in periods where we had a bullish high sentiment. So that's just another study that really brought some interesting information, I think, about the reliability of market forecasts in the US and elsewhere. A second one considered the value of macroeconomic forecasts by economists and others, and it found that there's a consistent underreaction in the expectations of economic forecasters and an overreaction in the behavior of individual forecasters. So collectively, let me say that more clearly, collectively, the forecasts were under too pessimistic, and individually the forecasts were too optimistic. So I guess it just goes back to the point is, these studies tend to really bring into question whether it pays to listen to these market forecasts and economic forecasts, because if you look at the data, it seems you would do better off by making decisions flipping a coin than you would by following the consensus view of market forecasters.
Well, I do have the old grizzled, been around for a while viewpoint on the individual stock research, and a lot of that, even though there's regulation against recommending something that the investment bankers are working on, historically there's been a bias to a Wall Street firm recommending something that they're trying to raise capital for.
Oh yeah. Mm-hmm.
And the other thing on the macroeconomic forecasting, the organization that tends to get it wrong the most is the Federal Reserve and their economic forecasts, and they unfortunately are the entity that spends the most trying to put together macroeconomic forecasts.
Those are both really interesting observations, especially I find the first one about investment banks and their forecasts being biased is a really interesting explanation for why, possible explanation for why U.S. forecasts tend to do worse than international ones. But the hard part about all of this is just the human nature factor that comes into play, right? We hear all these forecasts on shows like CNBC and Fox Business, and these guys, they're all these smart guys that are giving you these forecasts, and you think, boy, if they're warning me about inflation, or they're warning me about recession, or I better take that into account when making my investment decisions.
Well, I would point out in
It
the
really is.
majority of those cases, they're talking their own book.
Yeah, it's just, yeah, that's probably right. And it just goes to show that it's very, but what's the antidote? Are you going to turn off CNBC or what? Not watch Fox Business at all? Or maybe that's not such a bad solution for the average investor.
All right, guys. I think that about wraps it up for today. Just reaching that painful time limit that we all have to stay within. I know we all want to be talking on this podcast all day if we could, but alas, we got to stop somewhere. Just want to thank everybody for tuning in, for you guys for listening with us and helping out, of course. Always appreciated. I enjoy my time. And yeah, Andy, do you have an announcement?
Yeah, I just want to make a closing comment that because of the upcoming holidays and the fact that we're all going to be very busy with year-end reporting to our clients and meeting with clients to just review their portfolios and talk about their plans for the next year, we won't be doing a podcast until the holidays are over. So, but I want to remind our listeners that we do have our weekly newsletter, and that will continue in the interim. And you can, of course, subscribe to that through our website. And I also do a weekly market update for our clients and for anybody else who would like to receive it. If you'd like to be added to that, if you're not getting that now and you'd like to be added to the list, just drop me a line.
All right. With that, I guess we're all good. Thanks, guys.
All right. Have a great day.
Everybody have a happy Thanksgiving.
Happy Thanksgiving.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.